Yeah, I want to get on with some words that just came out by Mark Faber. Basically, it's some common sense words, too. I mean, that's really one reason I kind of really stay in tune with this guy because he's uses a lot of common sense. And that's really the only thing we got to go by more than anything. I mean, we can lie with statistics, charts, and facts all day because it depends on how microscopic you want to be in one area and concentrate on one area to make an argument. But looking at the overall big picture and common sense goes a long way. Basically, he says, and I put a lot of weight to this statement he made because I think he's being totally honest, unlike some other folks out there. I have no respect for Warren Buffett, to tell you the truth, but Mark Faber, I think he's being pretty honest all the way here. In the 40 years, he quote him, he says, "In the 40 years I've been working as an economist and an investor, I have never seen such a disconnect between the asset market, the equities, and the economic reality. GDP is not good, actually." And I pointed out a long time ago, which I thought was kind of funny, the garbage index. But since people are not throwing away too much, the GDP is probably even worse than it actually showing up in the actual federal government statistics. And then he goes on to say that asset markets are in the sky, and the economy of the ordinary people is in the dumps, where their real incomes adjusted for inflation are going down and asset markets are going up. And, that situation isn't going to continue. Really, there's make an argument to and back and forth, but it's like a little common sense does tell me the Fed is actually propping up the equities, the actual Dow and the S&P and all that. And a lot of it is in the area of real estate, too, because that's really where they're buying these mortgage-backed securities that are in trouble, and the bank's balance sheets have problems with some of their loans, and they'll buy them up. Now, the Fed is talking about ending QE, but I don't know how the hell they're going to do that because, that's the one argument that everybody says is like, how are they going to end it? Because when interest rates raise, and looking at the percentage of the budget that goes to interest, how could you really raise interest rates and also support the military the way it is today? That's another interesting thing because with Japan, 30% of their government budget goes to just paying the interest. How are they ever going to unwind their QE policy, their super QE? And I did say that actually short term, their QE has actually caused the Japanese QE short term has actually caused the commodities to go down because what they did was they made available lots of yen at very low borrowing cost to investors. So investors are borrowing yen and putting that money down in other areas that can give them a better return on the money. So basically a surefire bet until, the yen starts going down too drastically in value or whatever. But I want to point something else out here, just like an old cliche, and let's apply it to silver, let's apply it to the markets, let's apply it to anything. Basically, the cliche goes, it's common sense 101, but you got to look at it that way because that's the only way that's going to enable you to see through the mud, the fog. It's the fog of war. Investing is like the fog of war. When you're in the fog, you really don't know what's going on exactly. You try to look at all these statistics, but sometimes you're looking at the dirt right in front of you and not seeing the whole battlefield, right? But basically, this is a good one because I like this expression. It says the consensus rarely gets it right and almost always errs on the side of optimism. Now, you can apply that to, say, the silver consensus rarely gets it right and almost always errs on the side of optimism. A lot of people thought it was going to bust through 50. It's not going to stay down that long. It's going to go to 100. Later on, when it does get over 100, they're going to be saying 500,000, all this kind of garbage. Probably not. But it goes on to say the consensus rarely gets it right and almost always errs on the side of optimism, except at the bottom. And that's really, if you're looking at the psychological aspect of things, it looks like so many silver people are down in the dumps right now. They think it's going lower, and maybe we did have the bottom. Who knows? I know it's going to be a long summer, and I'm not sure, if it actually could go further down, but it's almost like the mood is so dismal right now. Who the hell knows? And you can apply this expression to the equities right now. The consensus rarely gets it right and almost always errs on the side of optimism. There's a lot of people saying 16,000 Dow. I don't think so, because that would actually be purely money printing. But then again, the Fed has started talking about ending its economic stimulus program. So, I think things are going to change around here. It's like when you're waiting for grass to grow, it sucks. That's all there is to it. But, putting the money into metals right now, even putting the monies into metals before when they're a little higher, but they still had pulled back, would have been a smart thing if you're going to be playing it out for a while. Now, later on, I expect, silver, gold, they'll hit crazy highs. It depends on what they do this year. We'll see the other predictions come out of the wall. Right now there's predictions out there saying that gold is going to be at least 1,600 by, sometime in 2013 again. I would think so. But, say that happened inside of a few months. Oh, they'd already be predicting some other thing. But like they said, it's one damn thing that's good to look at. The consensus rarely gets it right. It almost always errs on the side of optimism, except at the bottom. Now, that's not Mark Faber's quote. That's not his quote. But that almost describes his methodology pretty damn close. He's got that contrarian type of thing. But you got to look at also common sense facts 101. It's like I wouldn't necessarily, if I had like this cash and I said I didn't know where to invest it, I wouldn't be putting it in the general stock market right now at the height it's at right now. I wouldn't, no. Unless it's maybe in the mining sectors because they're so depressed. But with the thought of keeping it a while, maybe it's going to take 6 months to a year to 2 years before it goes way up. It wouldn't be like one of these one-day type trade things. I wouldn't be playing that game. But, the way things are, it's almost like everybody gets it wrong. That's usually like the moral of the story. The majority get it wrong. So, say for instance, silver does go explode in value. Let's make this assumption. Say it goes over 50, it goes over 70, it's getting near 100. I'll be selling some of it in pieces. I will not be part of the major consensus. The major consensus will be saying it's going to go much, much higher. I don't know where it's going to end up, but I do not think the dollar is going to totally go to oblivion. It's like it's going to lose a lot of its clout. It's probably going to be one of the world reserve currencies, not going to be the only one. As it is like the euro's a world reserve currency too. And in the dollar is the number one world reserve currency. It's just going to lose a lot of its clout. That's really what's going to happen. That's what I think is going to happen. I'm kind of like of the opinion of more in the middle on a lot of things too. So, but when silver does go up, we just remember what happened. Like even when gold went up to 1921 in August and early September of 2011. All the predictions came out. It's definitely going to be at least 2,000, 2,200 by the end of 2011. That was what happens. The consensus always gets it wrong. What I always picked up, what I found interesting, was Mark Faber says it looks kind of high now. It could possibly pull back. I'm not sure. It may pull back. Usually says he's not sure. When he says he's not sure, it may do this. I pay attention. Right now, he's saying the markets look too high. He doesn't know what is going to trigger it, but something's going to trigger it, and they're going to come tumbling down. That's what he thinks. So, where would you rather be, in metals or the markets? Because ergo, there is an inverse relationship between the general equities and gold, isn't there? So, right now the consensus is built up in markets, and oh yeah, rah, rah, rah. Yeah, nothing's sustaining them in reality. It's all by the Fed. Yet the Fed is talking about ending the economic stimulus program. How's that going to fare? So, we shall see. But just remember, the old cliche, the consensus rarely gets it right. It could apply to gold, it could apply to equities, it could apply to silver. The consensus rarely gets it right. It almost always errs on the side of optimism. It's not like they're deliberately trying to do it, but they get all excited about watching the curve go up. Except at the bottom, because everybody's in the dumps down and thinking, oh, it's even going to get worse. It's going to lose more than half its value again. And, silver pretty much, I guess from the height of 47 to 22, it lost more than half its value, didn't it? I don't know. Would it lose another half? I kind of doubt it. It's not Cabbage Patch Dolls, so just hang on.